Patience and long-term investing is a tried and true way to build wealth over the long term. In fact, did you know that over a 20 consecutive year period, you can take the S&P 500 any 20 consecutive years and never come out negative? You can do this by building a strong foundation of high-quality stocks, ETFs, and index funds. By focusing on quality, it helps keep your portfolio afloat during poor times, and it keeps your portfolio moving in the right direction during great times. As such, in today's video, we're not going to focus on an S&P 500 ETF. I have other videos covering that. Instead, we are going to focus on 5 forever dividend stocks. These companies are leaders in their respective industries, and they have proven to be great generators of cash flow and return money to shareholders via dividends and buybacks. So if you are excited about today's video, before we get rolling, do me a huge favor and click that like button down below, as that greatly helps the growth of this channel, and I truly appreciate it. Now that you've had a chance to do that, let's jump into the video. Hey everyone, Mark Rusin here, back for another video. As always, I am a CPA and not a financial advisor, so please perform your due diligence before investing in any stock or ETF, and do not take this as financial advice. When it comes to forever dividend stocks, the word forever could be a little confusing, as nothing is forever. There's a lot of things that can change the thesis, but these 5 dividend stocks that we're going to cover today are of the highest quality. Let's begin with our first forever dividend stock, which has actually been around the shortest duration of time, and that company is AbbVie, stock ticker ABBV. AbbVie is a pharmaceutical company that was spun off from Abbott Labs back in 2012, so they've only been their own public company for about 10 years now. The company has a market cap of $265 billion. Shares of AbbVie are even over the past 12 months, outpacing the S&P 500, which is down roughly 10% as of this video. All stocks have risks, and AbbVie is no different. The company has been led by the #1 selling drug in the world, which is Humira, but that has all come to a halt here in 2023 as Humira has lost its US patent protection, meaning many generic copycat brands can now start rolling out. These generic brands can be sold at a much cheaper price, which means Humira's sales will be on the decline here in the next few years. However, this timing has always been known by management, which is why the company has been expanding their portfolio, both within their own pipeline as well as through acquisitions. Here's a look at how much Humira's sales have grown over the past 11 years. They went from $7.9 billion in 2011 to over $21 billion in 2022. For years, Humira accounted for roughly 70% of the company's revenues, but in 2022, that dropped to 36% and will drop further moving forward. Why the drop in the percentage, you might ask? Well, the company has already lost patent protection over in Europe a few years ago. We just spoke about the patent protection loss here in the US for Humira, but it's also due to the fact that there's rising stars, other drugs within the pipeline that are now coming to fruition and growing at a fast pace for the portfolio. 2 of those drugs are Skyrizi and Rinvoq. They're both growing at an incredible pace. Both of these drugs grew over 50% during the year, with Skyrizi growing 75% in 2022. Since becoming their own public company, AbbVie has increased their free cash flow from $6 billion in 2012 to more than $24 billion in 2022. Strong free cash flow is what I like to see as a dividend investor. Speaking of the dividend, AbbVie pays an annual dividend of $5.92 per share, which equates to a dividend yield of 3.95%, which anytime it has crept over 4%, this has proven to be a great time to add shares of AbbVie. In terms of dividend growth, AbbVie has increased their dividend at an average rate of roughly 17% per year over the past 5 years, which is some amazing dividend growth. The dividend is also well covered with a low payout ratio of 41% and a free cash flow payout ratio of 43%, giving the company plenty of firepower to continue raising that dividend moving forward. However, payout ratios are expected to rise this year due to the drop in revenues expected from Humira, but the company expects to return to growth in 2024 or 2025. Currently, analysts are looking for 2023 EPS to drop to around $11 per share, which equates to a forward price-to-earnings multiple of 13.6 times. However, the stock has traded closer to 10.8 times over the past 5 years. Given the valuation, I am being patient to see if we can get a little bit of a pullback in the stock before adding, as it is already a sizable position within my portfolio. Analysts have a 12-month price target of $163 on shares of AbbVie. Before we move on, let me take a moment to thank today's video sponsor, which is The Motley Fool. The Motley Fool is a great resource for investors of all different levels. They have great products and tools for you to use to excel in your investing journey. Right now, if you go to fool.com/Mark, you could sign up for free to receive their top 10 stocks to buy right now. Definitely check out the link down in the description below. Forever Dividend stock number 2 is Johnson & Johnson, stock ticker J&J. Johnson & Johnson is a healthcare conglomerate operating in 3 different segments, one being consumer health, the second being pharmaceuticals, and the third being medtech, which is formerly the medical device segment. The company currently has a market cap of $395 billion, and on the year, shares have been hit hard. They are down nearly 11% and continuing to fall. J&J has had a rough go this year, as many healthcare names that worked in 2022 are not working to start the year so far. But J&J is falling a little faster than others. Reason being is the company has run into some legal troubles regarding their talc baby powder. They tried to pawn it off on a spin-off in which they created and then have that spin-off go bankrupt, but a judge ruled against that, to which the company has appealed, but since that ruling, the stock has fallen. Is this a risk? In the near term, absolutely, but it is also providing a great opportunity in one of the most well-run companies in the world. Johnson & Johnson is one of only 2 companies with a AAA rating, making them roughly safer than the US government. J&J is also in the process of spinning off its slow-growing consumer health business into a separate public company called Kenvue. This is expected to happen in Q4 2023. That leaves legacy J&J with the faster-growing segments of pharmaceutical and medtech. J&J has been a cash-printing machine over the years, and the spinoff will allow more opportunity to unlock shareholder value in these faster-growing segments. It could work out very similar to that of AbbVie. J&J is dividend royalty, as they have paid a growing dividend for more than 50 consecutive years, making them a dividend king. They have actually paid a growing dividend for more than 60 years. The company currently has a dividend yield right at 3%, which is rather intriguing, and the payout ratio is only 44%, making it a safe play. The dividend has been growing 6% on average over the past 5 years. Analysts are looking for 2023 EPS of $10.52 per share, which equates to a forward price-to-earnings multiple of 14.4 times, which is well below their 5-year average of 17.2 times. Analysts have a 12-month price target of $180 on shares of J&J. The third Forever Dividend stock we're going to look at today is Home Depot, stock ticker HD. Home Depot is the largest home improvement retailer in the United States. The company has a market cap of $292 billion. Home Depot is another stock like J&J that has had a rough start to 2023, and over the past 12 months, shares of HD are down nearly 10%. Home Depot is not faced with the same risks that J&J is facing with the legal troubles. Instead, they are trading lower on a slower economy and a slower real estate market. However, if you have watched my videos in the past, then you know that I talk a lot about being a long-term minded investor and taking advantage of these opportunities. Down markets create future millionaires. Home Depot is also one of the most well-run and efficient companies you will find. They also generate a lot of free cash flow, which allows them to pay a juicy, growing dividend. That free cash flow has consistently grown over the years, but exploded during the pandemic and has since fallen back to its regular schedule. Given that the real estate market is down, as home sales have declined for 12 consecutive months, this hits Home Depot a little bit harder than, say, the likes of Lowe's, as Home Depot dominates the pro segment. However, another angle to look at is the fact that higher interest rates could cause more homeowners to stay put and add more money into their current homes, which could help Home Depot and surprise a lot of folks. We will have to wait and see how that plays out. Let's now look at the dividends, since that's why we're here today. Home Depot pays an annual dividend of $8.36 per share, which equates to a dividend yield of 2.9%. Solid dividend yield near 3%, but where HD has excelled is with dividend growth. Home Depot has grown their dividend at an average annual rate of 16% over the past 5 years, plus they have increased their dividend for 13 consecutive years and counting. The dividend is also well protected with a low payout ratio below 50%. In terms of earnings, analysts are looking for 2023 EPS of $15.81 per share and 2024 EPS of $16.92. On a forward-looking basis, shares trade at an earnings multiple of 16.9 times, well below their 5-year average of 21.4 times, and below their 10-year average of 22 times. So below both of them, regardless of how you look at it. Home Depot also sports a strong A-rated credit rating. In terms of price target, analysts are looking for a 12-month price target of $334. The fourth forever dividend stock on our list is Coca-Cola Company, stock ticker KO. If any of you follow the great Warren Buffett, then you know that Coca-Cola has been one of his longest owned positions. And if you want a lesson on the power of compounding dividends, just look at how that has exploded for Berkshire over the years. The yield on cost is massive, and for those of you unaware with the term yield on cost is the current dividend you receive divided by your invested dollars. So if you invest in Coca-Cola Company today, your yield on cost is going to be the same as the dividend yield. However, as that money continues to grow and your dividend continues to compound and the dividend increases, the money you invested stays the same, but the dividend continues to rise the ladder higher and higher, and your yield on cost is what your original invested money is compared to what your dividend income is now. Today, Warren Buffett is earning more than 50% yield on his original investment with shares of Coca-Cola, just from dividends alone. It's pretty fascinating, and it speaks to the power of dividend investing and compounding. As for the Coca-Cola Company, they have an array of great products that continue to be in demand regardless of the economic backdrop. The company's CEO has also done a nice job focusing on their highest margin items and also adjusting product sizes, offering smaller cans or bottles, which have been a hit, especially with more health-conscious customers. Coca-Cola is a stock that will hold up regardless of the economic backdrop. They can more than hold their own in a recession and thrive in a boom. Coca-Cola has been paying a growing dividend for 60 consecutive years, also making them a dividend king. They currently pay an annual dividend of $1.84 per share, which equates to a dividend yield of 3.1%. Analysts are looking for 2023 EPS of $2.60 per share, which equates to a forward price-to-earnings multiple of 22.7 times. Over the past 5 years, for comparable purposes, shares of KO have traded at an average multiple of 26.4 times. And over the last decade, if we move things out a little bit further, shares have traded closer to 24 times. So under both of those, regardless of which period you look at. Analysts have an average 12-month price target on shares of Coca-Cola at $68.33, implying 15% upside from current levels. Definitely a name to have high on your watch list as we enter a potential recession. The fifth and final forever dividend stock is Microsoft Corporation, stock ticker MSFT. Microsoft Corporation is one of the largest companies in the world. They currently have a market cap of $1.85 trillion. After 2021, when tech stocks were unbeatable, FANG stocks and other tech and growth type stocks have come crashing down. Over the past 12 months, shares of Microsoft are down 13%, but they are holding on to a slight gain to start the year here in 2023. But there are some headwinds for the market ahead. Microsoft is a very well-rounded company, a major player with Azure Cloud, maintaining a top 3 position with Amazon's AWS and Google Cloud. Windows is also a dominant position, but PC sales have weighed on that sector. Gaming is another area they are looking to continue to expand through their acquisition of Activision, which is still pending, as this they believe has great potential. And how could I forget artificial intelligence with ChatGPT? The Azure Cloud business has been a growth driver for the company over the years, but as we've seen over the past few quarters, that growth is starting to level out and lessen. Looking at this chart here, you can see how various Microsoft products have performed over the past few years on a quarter-by-quarter basis. Windows OEM got hit hard in the most recent quarter, and Azure Cloud still offered 31% growth, but it was the third consecutive month of a slowdown. Nonetheless, knowing the headwinds that face the market right now, and also PC sales continuing to slow, and cloud expected to be again a little bit slower growth, shares of Microsoft could come back a little bit, providing an even better entry point for long-term minded investors. Having various products, both hardware and software, allow the company to continue to grow because if one area is slow, the other area can hold down the fort. Microsoft is a cash flow printing machine, reaching $65 billion in free cash flow in their most recent fiscal year. This has allowed the company to continue paying a growing dividend. When it comes to Microsoft, you get a mix of growth potential and strong dividend growth. Often you're not investing in Microsoft for the dividend alone, as the yield is quite low at 1.1%. However, the company has been growing that dividend at an average annual rate of 10% per year over the past 5 years, and they have increased their dividend for 18 consecutive years and counting, nearing that dividend aristocrat status. The dividend is also well covered with a very low payout ratio below 30%. Analysts are looking for EPS to remain largely flat on the year, 1% growth maybe, to $9.34 per share, which equates to a forward price to earnings multiple of 26.6 times, which is well below their 5-year average of 30 times. However, if we expand that out over the past 10 years, the average multiple drops to 23.4 times, which I would consider a great entry point for people to either enter a position or add. This is an area where I would be adding to my position in Microsoft. In terms of price targets, analysts have an average 12-month price target on shares of Microsoft at $292, implying 17% upside, but this looks a little generous to me. And like we saw with Johnson & Johnson being one of those 2 companies with a AAA credit rating, Microsoft is the other. Another reason they are a great long-term investment. So there we have it, folks. 5 high-quality, forever dividend stocks for you to consider for your portfolio. We have AbbVie, which is a pharmaceutical company, Johnson & Johnson, a healthcare conglomerate, Home Depot, the largest home improvement retailer in the US. You have Coca-Cola, the largest beverage company. And lastly, you have Microsoft, one of the largest companies, a well-diversified technology companies. And we also have 2 AAA rated companies. Let me know down in the comments section below which of these 5 is your favorite. Also, do you have other forever dividend stocks that you would consider? Also, if you haven't done so yet, make sure you hit that like button down below, as I greatly appreciate it, and we'll see you in the next video. Take care.